Recently, the Wall Street Journal reported that salaries for new hires are, quote, shriveling, adding that the worker bidding war is over.
Now, for those on the lookout for a new job, we're breaking down the numbers showing pay for new hires is going down. Before, employers struggled to fill open spots as many results of the pandemic, but that is starting to change.
Just 6 weeks ago, that same Wall Street Journal, along with the rest of Main Street media, was warning that wageflation is upon us, with greedy workers condemning us to hyperinflation despite the best attempts of the Fed. So here we are, wage-driven hyperinflation to shriveling in 6 weeks flat. So what is driving the shrivel? The Journal noted that after years of job hoppers getting fat raises thanks to pandemic-era labor shortages, also known as millions of people paid to chill on the couch at taxpayer expense, now companies are dropping pay for new hires, with the majority of job titles down on the year, in some cases by double digits. Note, inflation has continued, so that compounds to quite a pay cut. The worst plunges have been in IT, engineering, and transportation, which are all down around 20%. Business and manufacturing are both down around 10%. The Journal profiled one IT design worker who, quote, applied for more than 2,000 roles and only got a couple interviews, despite accepting salaries down $10,000 since last year. Another pizza delivery driver feels guilty that she's making $13 an hour when new hires are only getting $11. By the way, these sectors that are still rising are education and healthcare, which are both government dominated, basically continuing a 50-year trend where the government grows but the people shrivel. I mentioned in previous videos how the wage gains of the past year, which were barely beating inflation to begin with, were simply workers catching up, finally getting some trickle down from the Fed's trillions. This is because the way the Fed prints money is that they type in an Excel sheet and then they use that to buy assets like government bonds, mortgage-backed securities, and even corporate equities last time around. That means the money goes first to anybody who owns those assets, and it goes to borrowers, the federal government above all, and only after a long lag does it finally drip down to workers. Alas, it turns out those workers never quite catch up. Last time in the 1970s, workers got a permanent hit of about 8% of income. The trend shifted down. During Biden, it's already been close to 8%. We're only 2 years in. So what is next? 20% drops in salary offers could mean that workers trickle down, maybe drying up, shriveling, if you will, ending before it really even got started. If so, it means we may be entering the early stages of the recession unemployment dance, where companies first reduce offering pay, then they reduce hiring, then they reduce working hours, and finally come the layoffs. Okay, we'll be watching. See you next time.